Assalamualaikum warahmatullahi wabarakatuh. Today I'm going to talk about how Maybank Islamic manage their risk management. Maybank Islamic is currently adopting an integrated risk management strategy developed by the community of Maybank. So, the big community is Maybank and the small community is Maybank Islamic. So, Maybank Islamic take the risk management team from the Maybank community. So the strategy is to ensure successful control of organizational risk that rapidly evolving market climate. Risks are routinely handled by the bank with sufficient risk governance, infrastructures and resources incorporated around the Islamic community of Maybank financing of companies. The party shall continue to take constructive steps to address the different risks presented by a rapidly evolving market climate environment. The group continues to plan, track and respond to this internal and external risk factor in anticipatory manner, including the changing regulatory environment, external competitive environment and economic landscape. The risk management system that the group has placed is structured to meet these criteria difficulties. Next, we go to the Maybank Islamic background. Maybank Islamic Berhad is a subsidiary of Maybank. They are also the largest Islamic banker in the Asia Pacific region. It aims to meet the daunting trends in the Islamic banking environment and will definitely meet your Islamic financial need with a wide range of products and services. Maybank Islamic is a wholly owned subsidiary of Maybank, which acts as a subsidiary of Maybank Islamic funding arm of the Maybank Group. Maybank was the first domestic bank to do so. In Malaysia, the bank products and services are available in its 16 dedicated branches as well as in more than 400 branches of its parent bank and in the various distribution channels across the country. Maybank Islamic is the largest domestic Islamic bank in Malaysia by asset with an asset size of RM135.1 billion. The penetration of Maybank Islamic Sharia compliant product and services has grown considerably over the years. In 2014, Maybank Islamic will concentrate on strengthening its regional base in order to increase contribution from other entities within the Islamic banking community while retaining the bank domestic leadership role. After that, we go to the Maybank Islamic history. The issuer was incorporated under the Companies Act 1965 on 5 September 2007 under the name of Maybank Islamic Berhad, which is registered office on the 14th floor, Menara Maybank, 100 Jalan Tun Perak, 550 Kuala Lumpur. The key business location of the issuer is level 10, Tower A, Dataran Maybank, number 1 Jalan Ma'ruf, 59,000 Kuala Lumpur. The issuer is a wholly owned subsidiary of Maybank and the issuer is the Islamic funding arm of Maybank under the universal banking model. The issuer began operation on 1 January 2008 following the transition of its parent Islamic financing operation to the issuer. The issuer is primarily engaged in Islamic finance and the provision of associated financial service. Currently, the issuer has 16 independent branches in Malaysia, while at the same time leveraging over 400 domestic branches comprising fully fledged branches, service centers and private banking centers. Over 300 specialist centers comprising Maybank kiosks, auto finance centers, equity investment centers, business centers and SMEs and business finance centers from its parent network. That's all for me. Thank you.
Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh. My name is Muhammad Iqmal bin Fadil. Today I would like to share about risk management in Islamic finance. First of all, I want to share about definition of risk management. Risk management has several meanings, typically depending on the context in which they are addressed by the expert. Firstly, risk management can be defined as a formal process that enables the identification, assessment, planning and risk management. Other than that, also ERM describes business risk management as a mechanism structured to recognize possible incidents that may impact an organization and to mitigate risk within its risk appetite to provide fair confidence as to the accomplishment of the goals of the organization. The process is carried out by an agency which appoints a board of directors, management, and other employees, extended to strategy setting and around the enterprise. In its risk management standard, the Institute of Risk Management notes that risk can be characterized as a combination of the likelihood of an incident and its implication. In all forms of undertakings, there is a possibility for incidents and outcomes that represent an incentive to profit or a challenge to success. Risk assessment is increasingly regarded as being concerned with the positive and negative dimensions of risk. This norm also recognizes the danger from all viewpoints. For the conclusion, the general trait of the different meanings is that risk management is a management mechanism that tackles the risk posed by any organization, the danger to its resource and its implication as it chooses the challenges provided by its operating environment to maximize the profitability of the entry. Next, I want to share about type of risk. Firstly, about price risk is part of the Islamic financial institution perception that the value of the underlying material or asset that forms the basis of the deal between the Islamic financial institution and the fund group will differ from the original price. The exchange rate risk occur as the exchange rate for its borrowing and even the funding activity fluctuates. Secondly, credit risk is the uncertainty that the fund group is unable to fulfill its commitment to the Islamic financial institution when they are due. This is a speculative gamble performed with the expectation of a reward which the probability of a failure. Next, benefit rate risk is the risk that the profit created by the relationship contracts will not be as a invested or that the rate of profit indicated to the investment account holders of the institution will not be balanced. In comparison, some investment portfolio holders equate this rate of return to the interest rates paid by traditional banks and may transfer their assets to conventional financial institutions. Lastly, liquidity risk exists due to two major factors. Firstly, the inherent mismatch between the term of the source of the funds and the destination of the funds. Secondly, the risk that the funds received by the Islamic financial institution from the capital markets in the form of sukuk and intended to be repaid at that time. Okay, next, I would like to share about risk management in Maybank Islamic. Firstly, about risk management framework. Uh, Firstly, the principle that applied establish risk appetite and strategy. The risk appetite should be accepted by the board, which shall express the essence from and degree of risk and that the company is prepared to assume. Secondly, they also must assign adequate capital. It is because this principle is important because capital management is guided by business goals and represents the related regulatory, economic, and commercial context in which the company works. Next, they also must ensure proper administration and oversight rules. In this case, there is a straightforward, efficient, and comprehensive governance framework of the organization will define open and consistent boundaries of accountability identified within the group. Promote strong risk culture also one of the principles that must be able in the company. It is because institutionalization of a robust risk culture that encourage and offers appropriate expectation and rewards for professional and responsible conduct. Lastly, the principles that be applied are to execute strong risk management practices and processes. Good risk assessment systems are in place to actively identify, evaluate, regulate, track, and disclose risks inherent in all goods and activities performed by the company. Secondly, it's about risk appetite. First of all, the group risk appetite is an important part of the group's comprehensive risk control system and is guided by both top-down management and bottom-up management engagement at all levels. Our risk appetite allows the board and the senior management to collaborate, consider and evaluate the forms and levels of risk that the company is ready to undertake in the pursuit of its market and strategic while taking into account consideration in a stress setting. Risk appetite is embedded into the strategic planning process and is dynamic and sensitive to evolving internal and external drivers such as business dynamics, stakeholder preference, and internal capacities. In addition, the budgeting mechanism aligns with the risk appetite to ensure that the expected income from market operations is aligned with the risk profile defined. Our risk appetite also offers a clear view of risk structure and its roots in day-to-day business practices and decisions around the company. Lastly, driven by these values, our risk appetite is expressed by a series of risk appetite statements for all material traits around the group, which will ultimately balance the group strategic goals. Lastly, I want to talk about risk governance and oversight. The governance model embraced by the group offers a formalized, open, and efficient governance system that facilitates the active engagement of the board and the senior management in the risk management process in order to ensure a clear understanding of risk within the group. Moreover, our governance model positions liability and ownership at the same time as maintaining an acceptable degree of independence and division of duties between the three lines of defense. This is the risk assessment typically takes place at various organizational levels and focus on different levels of board sector lines monitoring and accountability rules. Uh, Lastly, the map outlining the company's risk governance system can be found in the corporate book group risk survey.
Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh. My name is Muhammad Fudi Mamarasli and I will continue the presentation with credit risk. Credit risk. Quality risk associated with abrupt shifts in credit quality. Credit risk is the risk of loss of principals or profits resulting from the inability of the obligor or counterparty to fulfill the contractual obligations in compliance with the negotiated terms and conditions. The group handles credit exposure using two strategy, which is managing the credit risk and managing the credit portfolio. So the aim of credit risk management CRM is to keep credit risk within the bank's risk appetite to a reasonable level. The group risk appetite is an important part of the group's stable risk management structure, which is guided by both the top-down leadership of the board and the bottom-up participation of management at all stages. Next, I will continue with the credit risk management. There are two types of management, which is management of concentration risk and asset quality management. So, management of concentration risk. The concentration risk can emerge from undue exposure to a specific counterparty and associated individuals, a specific instrument, or a particular business segment or sector. In handling broad exposures and preventing excessive accumulation of credit risk in its leasing and funding portfolio, the group has set limits and associated lending guidance among above. And then asset quality management. The group has specialized teams to handle insecure business, institutional, and customer credits efficiently. Specific consideration is paid to these vulnerable loans where more regular and intensive assessments are carried out in order to avoid further degradation or where possible to accelerate remedial intervention.
Assalamualaikum warahmatullahi wabarakatuh. I'm Muhammad Haikal bin Ishaq and today I will discuss about market risk. Market risk is defined as the risk of loss or adverse impact on earning capital resulting from fluctuation in market rate or price such as interest rate, foreign rate, currency rate, commodity price and equity price. The group manage the market risk of its trading and non-trading banking activity using a variety of measurement and control techniques. The first risk is trader market risk. Trader market risk arises mainly from proprietary trading, flow trading, and market making activities. This activity may create position held with a commercial aim to express them a market view to benefit from short-term price movement or to lock up arbitrary profit. The trading portfolio is governed by trading book policy and procedure as well as by trading limit. The policy requires the management of market risk traded by the group. Limit to be set for monitoring the risk measure outlined below. The first, value at risk. The group used the value at risk model to measure the potential losses of trading book resulting from the market movement over a specific period of time. The probability of occurrence is given. Second, risk sensitivity. The risk sensitivity of the trading portfolio to interest rate movement is measured using the present value exposure at the single basis point. Next, non-traded market risk. Non-traded market risks are primarily inherent risks arising from banking book activity. The major risk classes are the interest rate risk and risk of foreign exchange. Interest rate risk defined as the risk of loss of earning or economic value on bank book exposure resulting from interest rate movement. Sources of the interest rate risk include reprinting, base yield curve, and risk of option. Next, foreign exchange risk in the banking book. Foreign exchange risk is the risk of loss of value due to exchange rate movement. Exposure to foreign exchange risk can be attributed to the structural and non-structural position. Structural foreign exchange risk positions are primarily net investment in foreign branches and subsidiaries, whereas other foreign exchange positions are of a non-structural nature. Next is equity risk in the banking book. Equity price risk is the risk arising from movement in the price of equities, equity indices, and equity basket. The objective of the equity exposure is to determine the nature and extent of the exposure of the group to investment risk arising from the equity position and instrument held in the banking book group. Holding of equity investment consists of quote shares that are actively traded on the stock exchange and unquote shares that are not traded on the stock exchange. Next, liquidity risk. Liquidity risk shall be defined as the risk of adverse effect on the financial condition of the group or on the overall safety and soundness of the group arising from the inability or unexpected high cost to meet obligation. It is also known as the consequential risk, triggered by the underlying problem that may be endogenous. Balance sheet risk measure structure maintain a device and stable funding base while achieving optimum portfolio. This measure drive the design loan target to deposit ratio, source of fund to borrowing, wholesale borrowing, and swap market to support the growing asset base regionally. By means of this measure, the group shall shape its profile of asset and liability in order to achieve its desired balance sheet status.
Assalamualaikum warahmatullahi wabarakatuh. My name is Muhammad Ihsan bin Muhammad Fauzi, and today I will present to you regarding on how Maybank Islamic Berhad control their non-financial risk. Before that, let me explain to you what is non-financial risk. Non-financial risk is any other risk than traditional liquidity, credit, and market risk. It is not considered as a core or directly related to the main business, but they can have negative strategic, economic, and reputational consequences. How Maybank manage their non-financial risk? Maybank Islamic Berhad ensure that the risk methodologies and tools complement each other in order to effectively identify, assess and measurement, control, monitoring and reporting. They use tools such as KRI, Key Risk Indicator, as a warning signal to the group about the risk that they face. Secondly, they use IMDC, which is Incident Management and Data Collection, as a centralized database for them to look at operational hotspot loss. And they manage to control their non-financial risk by three key instruments, which is outsourcing. Outsourcing is basically they invite external party to engage in their business while the group still maintain ownership. Secondly, anti-fraud management, in order to ensure that the risk rising from fraud managed in a decisive, timely and systematic manner. The group has a comprehensive tools aligned to the established vision, principle and strategy. And lastly, BCM, which is Business Continuity Management. In the event of disruption, BCM serve as a tool to respond effectively to the interests of its key stakeholder, reputation, brand and value creating activities. Thank you.
Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh. My name is Muhammad Shakir. So we go to the next slide, which is definition of Sharia governance. There are three statements that can define as a Sharia governance definition. First, Sharia governance framework refers to the set of institutional and organizational arrangement through which an Islamic financial institution ensure that there is effective independent oversight of Sharia compliance over each of the following structures and process. Second, Islamic financial institutions have the obligation to guarantee the consistency with Sharia standards, taking all things together part of their items, instrument, task, practice, and the executive, which will be accomplished by the foundation of a legitimate Sharia administration structure. And third, the group set up an extensive and sound Sharia governance framework to guarantee powerful and productive oversight by the board, Sharia committee, management and business units on business exercise and activities of Islamic items and administrations complete by the group Islamic banking organizations. Okay, now we proceed to the next slide, which is risk of Sharia non-compliance. There are three risks of Sharia non-compliance. First, riba. Second, gharar. And third, gambling. So we go to the riba first. Riba in terms of language means increase or surplus. The indeed increase or surplus in the loan. Usually, that commonly occurs during the age of ignorance among them is in front of transaction of sale and purchase by them. After the payment period and the buyer unable to pay, the seller will extend the payment period and increase the amount of debt that must be paid. And second, gharar. Gharar generally means danger, disaster and risk. Gharar related to the sale and purchase contract, which is banned because it contains elements that may lead to disputes between buyers and seller. And third, gambling. Gambling means any activity that involves betting where the winning party will take all bets and losing party will be lose. Okay, we go to the next slide, which is implementation Sharia governance in Maybank. There are several ways that Maybank take action to prevent risk of non-Sharia compliance. First, Maybank make sure broad oversight, accountability and responsibility of the board, Sharia committee and board committees. Second, establishment of function for Sharia advisory and research, Sharia risk, Sharia review and Sharia audit. Third, Maybank make an oversight, guidance and observance by executive committees. And fourth, accountability of the management in ensuring compliance to Sharia requirements in its business operation. Okay, last but not least, as a conclusion, In a nutshell, risks need to be handled wisely and viewed in long term. Therefore, risk management is very important in an institution, especially banking institution. The reason is the company can save money and secure the future by adopting risk management strategy and considering the multiply possible threats or incidents before they arise. This is because a comprehensive risk management strategy will assist a business to build mechanisms to eliminate future risks, mitigate their impact if they arise, and cope with the outcomes. This risk awareness and management capacity helps company to be more secure in their decision. Additionally, sound corporate governance principles that concentrate directly on risk management will help a business or bank institution achieve their objective. That's all from us. Thank you for watching. Assalamualaikum warahmatullahi wabarakatuh.